Growth investing. They hold some reason why investors bet their money in stock to get some more in return. This is only possible when the right strategy is used while betting the money. But wait, there isn't a hero strategy that works for all. There's a dozen and dozen of investing strategies made by stock market experts. On such a strategy is one of the strategy is the investing, which is one of the favorite for the investors who want to make good profit. What is a growth investing a strategy? This strategy where the prime focus is to increase the investor capital. In this strategy, the money is placed on stock for small and new companies whose earnings are expected to grow at a certain level. But uh, but to what threshold? If you have asked the question to yourself, you are heading in the right direction. In the growth investing strategy, the stocks of the young companies are bought whose earnings are expected to increase above the range compared to the industries or overall market. When we speak of the word investing, the risk always comes with the sense the growth investing strategy involves buying from a young and small companies. The risk along with them is also high. The statistical and thoughtful insight for high risk is because these companies are untied as they are new. On a positive note, if the companies outperform their business, there's a good chance of booking a higher return in the forthcoming or near future. Growth investors and how they are different. So there are several ways one you can invest, especially in stock markets. A certain percentage of stock markets buy stocks and hold them for a long period, while a few sells them in a short span. There are also day trader who buy and sell the stock on the very same day. Apart from such an investor, that they are growth investors. The focus of the growth investor is to invest in a small and young companies that are believed to outperform in the industries in the coming year. It's a high risk investment but involves a huge profit in returns which allures the investors. One of the worrisome subject of the growth investing is the proper research and performance. If the company fails, you are losing your money and blindly, and investing in a small companies will only help you in a lot. So good research is to be conducted considering the vision of a young companies. This is because you will be holding on the investment for a long period and waiting until your profits are mature. The profits are in a form of a capital appreciation, which is the goal of a growth investor. Apart from this, growth stock companies also invest their profit back in the business to avoid paying divided to their shareholder. The P by E ratio of growth investor. If you are a new investor, you might unaware to of the P by E ratio. It is used by the investor to evaluate if the companies have enough asset to liquidate when the company is failing. A short P by E ratio signifies the company has more assets than liability and is preferred by investors. In growth investing, the idea is to place the money on a small and a young companies. In such scenario, it is a nature to have a high P by E ratio as the company is hiring either a small or a young and doesn't have enough assets. So this is a statistical way of conveying there is a high risk of growth investing and it is natural. The core of the entire growth investing concept is that the company will expand, prosper, and the growth in earning or revenues will turn into a higher stock prices. The young companies may not have assets or earnings in the present situation but are expected to grow and have in future.